It's not just been recently, we've been in a low interest rate environment for a while, mainly in governments, but more recently, since about February last year, we've seen a massive rally in investment grade credit and also high yield credit, which took those yields quite low. So there are places to go, but you have to go and find them. And we think, for example, bank loans is a good place to be. There you can get about 4% yield. Some areas of high yield as well, although you have to look quite deeply. You could get about 5.5% in high yield. Another area that we see quite good value, and in particular quite nice yields, is the mortgage-backed security area, but those that are not agencies, so the non-agency mortgage-backed securities. Here, very careful, because you really have to do your bottom-up and your deep analysis. And I would say another area would be emerging markets, and in particular the local government emerging market. And here you can see yields of between 15 and 20%, for example, Argentinian local debt. And other areas, for example, Brazil, you could get about 10% yield there. Mexico and Russia are offering you about 7 to 8%, and about 5 to 6% in Colombia. So there are places to find that higher yields, but definitely not without risks. High yield and investment grade credit, in general, we've seen a quick rally, a strong rally, so there is not that much left there. Taking investment grade on one side, maybe instead of looking at the index as such, looking into the sub-industries, things like metals and mining, things like energy, some parts of financials, in particular the subordinate to financials. There is some value to be had there, but very important to do that bottom-up analysis. In high yields, it's more, maybe instead of sub-industry, it's a bit more what credit rating you could look into. The lower credit rating, i.e. more risk, you're going to get better yields. But obviously, you're closer to that potential default, so very careful what individual names you buy there. In terms of bank loans, is one of those asset classes that has been a bit more demanded recently, because they tend to be floating rate notes, and with this outlook of increasing rates, so increasing Fed rates, we might see more demand of this asset class. It is a bit less yielding than high yield, but definitely less volatility than high yield as well. So potentially a good one to have in your portfolio as well. On the emerging markets, out of the three legs, the sovereign in hard currency, sovereign in local currency, and the corporates in hard currency, I think the one that has more value is the local currency, as we mentioned before with those levels. Now, very important to do not the analysis just on in the country and with the bond, but also on that currency. If that currency has rallied enough, you think, like might be the example of a Brazilian real, where we saw a very strong rally in 2016, maybe potentially the upside is not as big as the downside. So situations like that, you might be willing to hedge that currency out. But very much local currency, sovereign debt in emerging market, they are offering quite a good level of yields at the moment. We don't expect to see a rally that we've seen since mid-February last year, or even the continuation that we saw since maybe after the elections in the United States last year as well in November. But we could see a bit more of contraction of those spreads. Now, definitely not to the levels or to the speed that we saw since, like I said, February last year. Talking about GMS, the fund, it has a yield of about 4.8%. We think that maybe going forward is an income play. It's based on that type of yield. Assuming that you're getting that yield, which is what we're getting in the fund, maybe adding between 1 and 2% points potentially of that potential capital appreciation, that would be the result. So starting from 4.8 and then adding about 1 or 2 points, around the 6% return going forward could be potentially correct.